Hello, welcome back to 5 o'clock Finance. We've got our drinks poured. We're ready for this next week's installment where we'll be talking all about investing. And today we have Brionna DeVos joining us. For those of you new to the series, Brionna is a CFA and an MBA. Incredibly impressive. She has a background in wealth management. And she currently is at Ernst & Young Parthenon as a strategy consultant. So we're really thankful that she's here to try and help us understand finance. So thank you, Brionna.
Of course, thanks for having me again.
Yeah, so with that being said, we're just going to dive into all things investing today. I know, when I first started thinking about investing, it honestly was pretty overwhelming. There's a lot of different options out there and a lot of confusion, stocks and bonds and all these different ways to trade. And the more you get into it, the more overwhelming it becomes, short selling, oh my gosh, whew. And then it starts to get really complicated and confusing. So we're hoping just to get down back to the basics and really understand what type of, asset allocation can we aim for? What are smart investing decisions to make? So thank you for joining us. I think today we'll start just simple. For those of us new to the world of investing, what's the big difference between stocks and bonds? What are they?
Yeah, totally. So I feel like bonds are probably the easiest one to hit. It's a contractual obligation that you have with a company. So basically, similar to like student debt or car payments or whatever, basically the company is being lent money by you. And so in exchange for that, they give you what we call coupon payments that are usually like twice a year. So they're called fixed income instruments because you usually, like most bonds, you get a certain amount every 6 months. And then at the end, you get all of your money back. So you've given them a bit of money, they give it back to you, and then because they gave it back, because they gave it back to you in the future, they're giving you little money in between.
Got it.
Does that make sense?
Yeah, so a bond might look like, you buy $1,000 bond with, XYZ corporation. Maybe twice a year you get a payment in the mail, your coupon payment for $50 or something like that.
Yeah.
And then at the end of maybe 10 years or however long the bond is for, then you get the $1,000 back.
Yes, although it's usually automatic in your account, not usually in the mail.
Yeah, I'm just...
You've been around for a while?
I think it's simple for the listeners.
Yeah, well, in comparison, stock is equity ownership, and what I mean by equity is like you own a fraction of the company. Okay. So in simple terms, if there were 100 shares that existed for a company and you own one of those shares, you own 1% of the company.
Got it.
Now, the reason stocks go up and down is a function of the whole company becoming more valuable and less valuable. Another, that's what we call capital appreciation. The other part of stocks is that you do receive a dividend, or it can receive a dividend. Similar to fixed income of that you receive, X coupon payment every 6 months. Some companies do have dividends that they give out to their shareholders, and they're usually a flat percentage every I would say 3 months or 6 months, something like that.
Got it.
But not every company offers dividends. Yep. It's just an option that some companies have.
Okay.
Yeah.
Great. Yeah, that makes sense. So with these two kind of big options out there, how do you know, should I be investing in stocks or bonds, or is there a right mix to maybe have in your portfolio? Yeah,
so I get that a lot. I'm going to keep coming back to this. It depends on your goals, but in this particular case too, it also depends how much time you have until retirement or what phase of life you're in.
Yeah.
The longer your time horizon is, so let's say you retire at, I don't know, in 30 years or something, the longer out you are, the more risk usually you're able to take. The closer you end up getting to retirement, the less risk you want to take because you don't want to lose all the value that you've been saving up for so long.
Sure.
So that's like an approximate. The other part is also your risk tolerance.
Yeah.
So there are some people who are very risk adverse. So you've heard the grandma and grandpa who put like cash under the bed or whatever. That's very risk adverse. So people who are risk adverse tend to like favor fixed income products because like a bond, just because it's like it feels safer, it's less risky, but you don't get the same level of return on the back end. So those are the two big considerations. If you're going into your individual account right now, what I recommend as like a baseline of where to start is a lot of companies like the Vanguards and the Fidelities of the world, they have these things called target date funds.
Okay.
And so the idea is that this target date fund figures like if you know what year you're going to retire in, then you can look at the allocation of that target date fund right now to like fixed income, equities, cash, alternative products as well. And then you can use that as a baseline of like, okay, this target date fund right now says that like 60% of its assets are in stocks and 40% are in fixed income. For people who are like me going to retire in X number of years. So that's at least like a basis to kind of like to check you back into like, okay, like you can tap into like what people for the most part are doing.
Right.
And then you can either ratchet up the risk or ratchet down the risk based on your circumstances.
That makes a lot of sense. And for people who are looking at an investment, let's say they're looking at a bond or a particular stock, how do they maybe measure how risky it is or not?
Yeah, that's a good question. So a thing that a lot of like investment analysts look at as like first sector. Mm-hmm. So technology, as a lot of people I'm sure have heard a lot about, like the Amazons of the world and the Apples of the world, like they are so highly valued because there is the expectation that there's going to be a lot of growth.
Right.
Now with growth comes variability. So they are riskier comparatively to something like a utility stock, which you can't stop paying for water, really. Yeah. Like everyone doesn't just stop paying for water or like for electric or whatever, unless there's something like a pandemic. Yeah. But like for the most part, they're more secure. Right. So like that would be a good place to start in terms of like, in terms of sector of like how like risky or not risky a company is. Now, if you're going about the business of buying individual securities, you need to keep digging deeper. So like if I were interested in something like Apple, you need to like go deeper than just like the sector. You need to go deeper in terms of like how much money are they making every month? What does their leadership board look like? What's their vision for the future? How many people are buying new iPhones or, things along that nature. Like you need to keep digging if you're going to take the bet of like, I'm going to buy an individual security.
Got it.
Or you should. I would recommend that you do.
That's great. And, I've heard about these quite a bit, index funds. I'm sure we all have. But for those of us maybe new to index funds, could you give us like a brief little intro as to maybe what they are and how you can invest in them?
Totally. So circling back to, I believe, week 2, when we talked about active versus passive management, index funds are the quintessential passive fund. So the index fund, either a mutual fund or an ETF, we could talk about the difference of what those are later. They buy an underlying index. So when you hear about like the Dow Jones or you hear about like the S&P 500 or whatever, like those are an index that have been created based on a certain set of rules.
Got it.
Now, an index fund usually is like investing in those like individual stocks on your behalf. So like the S&P 500, if I were to buy one stock from every single company, it would be expensive, right? Like that's not really attainable for the average person. I can buy a certain amount of the index fund and get that exposure on a smaller level. So that's why people like index funds, because they don't have to go out and like even the trading costs associated
single stock,
that and like the cost associated with like buying all of those, like the trading costs. It's like, I mean, you're losing value when you do it that way, as opposed to I can just buy an index fund. It's one trading cost, and then I have that exposure that I was looking for.
Great. Yeah, that's super helpful. And then lastly, for those of us hoping to become maybe smart investors, do you have any tips or tricks for anyone out there as to maybe how to make evaluations in terms of smart investments?
Yeah, so I would say the first is don't put all your eggs in one basket.
Yeah.
Diversification is important, and what I mean by that is like 100% in Apple. I keep referencing Apple because it's top of mind.
You're not promoting purchasing any type of stocks here.
No, I do like their company, but like going 100% in one is risky, right?
Yep.
The more investments that you are exposed to, like the less your risk is, because it's like if one goes up, the other one goes down. There's like some sort of stabilization that happens when you have more investments. That includes underlying, investments of like an index fund. If I'm buying in an index fund, if like Apple goes up and like AT&T goes down, they kind of net neutral. Like that counts as diversification too.
Sure.
The second thing I would say is like similar to all things in life. If it's too good to be true, it might be.
Yeah.
So we were talking earlier about like the Teslas of the world, right?
There's some hot stocks that everyone's buying.
Yeah.
And, I'm going to throw this term out there, but they're trading for, much higher than their market comparables.
Right.
And so it's a little bit alarming, why is this one trading at 200x,
Yeah.
PE ratio versus another one who's trading at 3, and they're very similar companies.
Yeah, absolutely. I mean, like Tesla's total valuation right now is higher than Ford, right? Which is kind of crazy, right? But like the idea is like if something seems too good to be true, or you're buying like a hot stock or something like that, you need to dig further, right? As opposed to like, you're out at a bar previously before COVID. Yeah, so I would say diversification is the big one, and like if it's too good to be true, dig further.
Yeah.
Those are probably my two biggest ones.
Great. Well, thank you so much again for joining us, Brionna.